Hi, everybody. Welcome back to Ox Talks. Thanks for watching the show today. I appreciate the support for this channel, which is growing. If you would, please hit that thumbs up button for me, the bell notification. Share this video with people as many people as you know, especially young people this might apply to, or actually any age that are just not being financially responsible and digging the hole deeper. The article I'm going to share with you in a couple of minutes. Hope you're having a fantastic weekend, spending some quality time with loved ones and getting something accomplished. Hope you guys are making a productive use of time. I'm trying to do some projects here around the house this weekend before the end of the year. And if you don't mind, subscribe to the channel. If you're not subscribed, just punch that subscribe button. So this is an article I saw just a few minutes ago from the Financial Times. I did a video the other day saying that I'm really optimistic about 2025, what I think it's going to bring for a lot of people. However, when I see this article today, it makes me question whether or not all segments of our society are going to be able to take advantage of opportunities. And this leads me to believe that the answer to that question is absolutely not. And the reason why is this. Many people in this country simply don't get it. They don't understand what it takes to be successful. They don't understand what things you have to avoid, in order to be successful and get ahead. Okay, now, there are always caveats to that. Okay, there are financial things that come up, unforeseen events, medical issues, a loss of a job. I get that. I'm not speaking to those people necessarily, okay? And for those folks, sometimes you have to tap into this toxic debt system to get liquidity to cover unforeseen expenses. So don't beat me up in the comments. This is for those that have no business spending the money they're spending. And I will tell you, to those people, man, it's probably not most of the folks that watch this show. However, you probably have a family member or a loved one, or maybe a son or a daughter or a grandchild that is simply making irresponsible financial decisions. And some of these decisions can literally haunt these people for years and years. And it becomes this never-ending cycle of abuse, okay? I'm talking about the credit cards. I'm going to share the story with you in a minute. But please share this video, because we need to start waking people up so that they do not literally destroy their future by getting into debt. And a lot of these folks, they get into debt and then they end up in the bankruptcy court. Okay, I see it all the time. And guess what? It becomes this vicious cycle where every 7 years they're right in the bankruptcy court because they have too much credit card debt. They never improve their credit score. They're never credit worthy for any kind of good debt, okay, that can possibly better their future. This is out of the Financial Times. Says U.S. credit card defaults jump to the highest level since 2010. So basically 15 years we go back to a time when credit card defaults were this bad. It says defaults on U.S. credit card loans have hit their highest level since the wake of the 2008 financial crisis, in a sign that lower-income consumers' financial health is waning after years of high inflation. Okay, but a lot of that is lower-income consumers just don't understand the tools to financial success. And they need to be watching more channels like this channel and others. They're trying to educate people, not financial advice, not legal advice, just saying, wake up, stop doing stupid stuff, okay? It says credit card lenders wrote off $46 billion in seriously delinquent loan balances in the first nine months of 2024. That's up 50% from the same period in the year prior, and the highest level in 14 years, according to industry data collected by Bank Reg Data. Write-offs, which occur when lenders decide it's unlikely a borrower will make good on their debt, are a closely watched measure of significant loan distress. And guess what? For all of you people that think that's great because the credit company will eventually write off the debt if you don't make the payment for 90 days or 120 days, look what happens to your credit. Okay, they will ding your credit. It's as bad as a foreclosure or a bankruptcy in many respects when you have all these write-offs on accounts. You don't even need more, you just need one, okay? And your credit is going to be in the tank. It says high-income households. Now listen to this. There's a reason for this. High-income households are fine, but the bottom third of U.S. consumers are tapped out, said Mark Zandi, head of Moody's Analytics. Their savings rate right now is zero. Again, I understand if you're in the lower income economic strata, you have less disposable income, okay? But that's even more reason why, unless there's a exception, financial emergency, loss of a job where you have to tap a credit card, or let's say a medical emergency, unless you have one of those few caveats, you literally should not be using credit cards. Literally, you should cut them up and do not use credit cards. Pay as you go or don't buy it. The sharp rise in defaults is a sign of how consumers' personal finances are becoming increasingly stretched after years of high inflation, as the Federal Reserve has left borrowing costs at elevated levels. Banks have yet to report their fourth quarter numbers, but the early signs are that more consumers are falling significantly behind on what they owe. And I'll make a comment there. These stats don't even include the fourth quarter. Guess what happened in the fourth quarter? All the Christmas spending, all the holiday spending, all the Halloween spending, right? So wait till those numbers come out first quarter of next year, and let's see how the delinquencies, how the number one, how the levels of debt rise, and number two, how the delinquency rates rise. Capital One, the U.S.'s third largest credit card lender after J.P. Morgan Chase and Citigroup, recently said that as of November, its annualized credit card write-off rate, which is the percentage of its overall loans that are marked as unrecoverable, hit 6.1%. That's up from 5.2% a year ago. It's a substantial increase. Consumer spending power has been diminished, said, I can't pronounce this name, Odysseus Papadimitrou, head of consumer credit research from Wallet Hub. Well, one reason consumer spending power has been diminished is because these folks, again, the bottom third, have literally tapped out their credit lines. Why do you think the higher income households don't have this problem? You might say, well, because they make more money. Yeah, but higher income households also have bigger obligations. They have more going out. So a lot of that is relative. It's also because they don't have the negatives. This is not blanket, but a lot of them don't have the negative spending habits that the lower income folks do. They just don't understand it. They're not seeking out financial education. Okay, they believe, a lot of these folks, that having a limit on your credit card is like having a savings account. Okay, it's not. It says the sharp rise in defaults, I read that. Consumer spending power has been diminished. U.S. consumers exited pandemic-era lockdowns flush with cash and ready to spend. Yeah, flush with cash that was given to them in many respects. Credit card lenders were happy to help, signing up customers who might not have qualified in the past based on income, but looked like safe debtors because their bank accounts were flush with cash. And I will say some of that is on the banks, right? Just like in 2006, 7, and 8, when the mortgage lenders were handing out, home loans on stated income like Skittles to people that never should have been buying a home. Okay, so we have the same kind of that going on in some respects with the banks, right? They don't care. They just want you spending. It's a debt-based system. However, ultimately, the blame rests with you, right? You have to make the decision if you're going to apply for that credit card and you don't pay it off every time you use it, especially for, let's say, if you have a lower credit score, you're paying a higher interest rate. You're paying more fees, more penalties when you're late. Okay, if you're in that bottom third of the economic strata, okay, of the income earners, you're paying more to be able to have, let's say, the privilege of using these credit cards. Those are the ones that should be least using them, okay? Credit card balances soared, rising a combined $270 billion in 2022 and 2023, pushing total U.S. consumers owed on credit cards above the $1 trillion mark for the first time in mid-2023. That spending, along with pandemic-induced supply chain bottlenecks, led to a burst of inflation, something that prompted the Fed to boost borrowing costs starting in 2022. Means rates went up, That means the interest rate you're paying on your credit card balances also went up at a time when the cost of everything else is going up. So, okay, double whammy. Okay, we know that. Everyone's getting pinched. Okay, I just got my my auto renewal insurance bill in the mail on Friday. I almost fell off my chair. I got my medical insurance renewal bill 2 weeks ago. Again, up hundreds of dollars per month. It is choking everybody. But the ones that have less disposable income, if you're not making that much money, those are the people that need to be watching this more carefully than anybody, because they don't have reserves. They don't have the ability to dig out of the hole and simply write a check for the balance on their credit card whenever they want to. Okay, they're not going to go find that money. Higher balances and interest rates have left Americans who cannot pay off their credit card bills in full, paying $170 billion in interest in the past 12 months, ending in September. That sucked up a portion of the excess cash that was in consumers' bank accounts, meaning they're using what they do have, possibly in excess money or savings, to just simply service the interest debt on the credit cards. They're not even paying them off. They're just basically keeping the balls in the air so they can keep using the cards. It is a downward death spiral, folks, I'm telling you. And those of you that have younger people in your lives, I know the average age on this channel is higher like mine, but those of you that have younger people that are using credit cards irresponsibly, please plead with them. Do what you can to try to break that cycle now. So it's a sign of how consumers are struggling even after writing off nearly $60 billion in consumer credit card debt in the past year. Another $37 billion remains in consumers' cards that is at least 1 month overdue. Credit card delinquency rates, which are seen as a precursor to write-offs, peaked in July, according to data from Moody's, but have only fallen slightly and remain nearly a percentage point higher than they were on average in the year before the pandemic. And in closing, it says delinquencies are pointing to more pain ahead, said Wallet Hub's Patamitru. So that's the article today. I know it's probably not a positive message, but hopefully it's a meaningful message and meaningful information for you to take to those. If it's not you, if it is you, please pay attention to this stuff. Do everything you can to stop this toxic spending on these credit cards, all right? Stop enriching these banks at your expense and your future, all right? I'll leave it there today. Sorry about going a little bit long. A beautiful day here in Southern California, so I'm here in the backyard wrapping up the afternoon. Gonna grab a couple more projects. Took a day off from working out today, just needed to rest. And again, I appreciate all of you guys very much watching these shows, supporting the channel. I hope we'll have a big year this year, or this next year in 2025, growing this channel and continuing to, just educate people, wake people up, and just build a nice community. So thank you very much again. Talk to you all soon. Bye.